Let's take excess casualty, and that's a stress point. What carriers have done, they've continued to reduce the amount of limits they're going to offer on any single risk. And then if you look at the market segments, let's say, for example, Fortune 5 business, they have difficult time finding the capacity they want to carry. Part of the creation is facilities out of Bermuda and also sharing capacity, kind of quota share arrangement with a larger retention for the insured. Hi, I'm David Corry, Head of Casualty for Argo Group, and this is the future of insurance.
David, it's great to sit down with you and have you discussing what I think is a different background from what we've tended to have lately. As you can imagine, with natural catastrophe activity, hail, it's been a lot of property damage kind of conversations. I'm excited to hear from the casualty side. So welcome to the show. And if you don't mind, give us a little bit of background on yourself and on Argo.
Well, thanks, Brian. So I've been in the insurance industry over 35 years, all on the carrier side and all in casualty underwriting roles and or management of casualty product lines. So I kind of say I kind of done it all casualty world. So I've done automobile, workers' compensation, general liability, excess umbrella, I've done large accounts, and all inclusive of environmental. And so today at Argo, as head of casualty, I'm responsible for our primary casualty, excess casualty, environmental liabilities, our construction liabilities, our workers' compensation. And then in Bermuda, we operate out of Bermuda, and we have a large casualty excess book there that I manage too.
So for those who aren't watching this on video, there's an airplane model behind you, and I keep waiting for you to say "and aviation," but maybe that's just an interest in planes themselves. But do you have any overlap with aviation or?
Well, I do. So I spent 29 years in the Air National Guard.
Oh, wow. Okay, so definitely very different than writing aviation insurance, but I understand why there's a plane in the background now.
Yes.
So for those who don't know Argo, tell us a little bit about real quick on the company. Obviously, you gave the framing of your casualty side and the Bermuda piece of it as well, but Argo more broadly as a carrier.
Yeah, so we're a specialty niche E&S company with a mostly emphasis in the United States, absent of some property business in Bermuda and casualty. We ride across the spectrum of the E&S casualty lines, and then we'll also have a segment where we write inland marine garage liability, and we do some specialty program business. And most recently, we're going to start up a tax liability unit at the company. Now we're based in the United States. In November of 23, Argo Group was acquired by Brookfield Wealth Solutions, which is owned by the larger Brookfield organization out of Toronto, Canada.
I'm a specialty lines person, and I don't get a lot of that on the show, so it's always nice to have people in the specialty realm on the show. When we talk about casualty, you can't get around social inflation, the litigiousness in the U.S., and what happens with just the ratcheting up of settlements. Obviously, there's a huge component of fraud in the casualty space as well. These are all drivers of kind of the challenge to sustainability or economic viability of casualty lines. Lots of carriers have had to pull out, restrict their appetite or pull out of lines or segments or geographies. How you've had a long career in casualty, how have you seen sort of creating something more viable than just sort of, in and out, back and forth, staying out of markets or, effectively painting yourself into a corner because there's a lot of areas that are tough to write in. What's your take on that to make it more of a viable path?
There's a lot there, as you said, a lot to unfold, trying to get all those areas. You touched upon a lot of issues. I think it speaks to, on a carrier side, as why the management must be very nimble in how they manage their portfolios, if you will. I learned early on in my career what was important is I would refer to as capacity management. That certainly has been a big trend in the last 5 years, I would say, in the casualty spectrum, where I would say my counterparts in the professional lines were probably better at managing capacity maybe 15, 20 years ago, and then it kind of migrated into casualty. What do I mean by that? Too much limit up on too many risks.
Yeah.
So part of the social inflation is today is certainly you need to work together very tightly between underwriting, pricing actuaries, reserve actuaries, and I would say also your claims department. So you really need to be thinking ahead and stay on top of your loss costs and the trends there in your various products to make sure that your pricing is taking into consideration the inflationary trends, whether that's social inflation, economic inflation, or these larger verdicts.
Yeah, of course, at least in GL, you get defense outside the limit, so that makes it even more complicated. And then on professional liability, it's all within that limit. Obviously, you can sublimit things differently, but GL's got that added complication that even if you control the actual liability limit, you're still paying for quite a bit of defense that is expensive and complicated these days.
It is, and what we worked hard upon is when, and Argo's not immune to this. We've had some issues historically also, and we did prior to being acquired by Brookfield, we had done a loss portfolio transfer to seed off some older claim book of business.
Yeah.
But I think what's important is that, we try to communicate to our broker partners. First, we did this internally, and that is by each of our products. So let's just take primary casualty as an example. We worked really hard initially internally identifying the classes of business that historically has performed well for us and those that did not. Now, that could be a whole class of business. That could also be a jurisdictional issue.
Yeah.
A certain state. So we made a decision to exit some classes of business. We exited some states. And then once we felt like we were comfortable with our target classes, then we, again, working with pricing, reserving, and claims so that we're communicating internally about what we're writing. There's no surprises here. We know what we're writing. And then we went out externally. And then the next step was to go external to our broker partners and identify with them, show them the classes that we want to write.
Yeah. When you talk about your brokers, are you primarily wholesale distributed?
We are for the casualty lines in the United States. It's wholesale distribution.
How do you think that fits in with when you need to make changes in appetite? And is that easier or harder than if you were retail? What do you think that the type of distribution plays a factor there?
Oh, absolutely. And you've seen, the fact that we write most, if not all of our business on non-admitted paper
Yeah.
in the wholesale spectrum. It does allow us to move quickly and rapidly on terms, conditions, and pricing. We try not to surprise our broker partners. We want to make sure that we're in it even though it's niche in an E&S, and by definition, you could say there's opportunities to get in on something and opportunities to get out if it turns on you. And we do some of that.
Yeah.
But I think it's important that we are somewhat of a long-term stable market for our wholesale partners.
Yeah. Do you see anything on the product side in terms of innovation, where people are thinking about new ways to create cover, or not just restrict it, but think about, okay, the exposure is different, the situation that the exposure is, or the context that it's in is different. Are you seeing? I would imagine, especially from E&S, you have the flexibility to play with the coverage to keep it sort of modern and in line with the exposures more so than the admitted market might. Do you see that sort of happening in these more stressed times where people are thinking about coverage and how to respond differently?
Yeah, in some areas, I would say probably there is somewhat of that going on. And in other areas, I think some carriers are just walking away, feeling like they can't, let's just take, for example, construction defect.
Yeah.
There's some states that's an issue with respects to continuous trigger, with
Yep.
respects to how difficult it may be to defend it. So you could put on some terms, conditions on the quotes or ultimately the binders and the issued policies that may not work for the broker and or the insured. It's very tight coverage. So it depends on the situation. If you can, offer very limited coverage, at least it's some cover for the insured. But that's the part of the E&S, our business, that we can change terms, conditions. And, I would say that, there's some areas that were created out of needs.
Yeah.
I would go back, I would say over 30 years ago, AIG, for example, were on the tip of the spear with the creation of environmental insurance.
Yeah.
Well, environmental insurance was an area where the carriers, the ISO carriers, started to put exclusionary language in the primary policies and then in the umbrella policies, and those exclusions modified over time. but to the point where, there were no, prior to that, there was not an exclusion for pollutants. So that changed with the exclusionary language, and that created a market niche. What happened? Well, the industry wrote policy language specifically for pollution.
Yeah.
All right. So in one regard, you couldn't write it on a GL form because what you said earlier about unlimited defense. So you write it with terms, conditions, definitions, and exclusion insurance agreements that are tailored for pollution coverage.
Yeah.
And boom, you have a sustained 30+ year market for environmental insurance.
So your comments give me two questions I want to dig into, and I can't pick between them. So I'm going to throw them both out there, and we'll see how the conversation goes. But on the one side, it's, do you see an analog emerging today where there's a new, potential kind of vertical or subsegment that could be developing its own cover? And the other question, which is maybe a counter to that, is, are the pressures around coverage and the sort of economic viability of offering it today different from the ones that would have, spawned the environmental cover that you were just talking about? And so it's less about a new product emerging, and it's more a widespread sort of like, we need to figure out how to make these lines of business work full stop, not just in a pocket of it.
Well, as far as new areas of insurance that create, I think part of that is new entrants into the business. So I think part of that, I would say, part of my response to you on that is, there continues to be money and companies invested in the industry and coming onto the industry.
Yeah.
So if you don't have the legacy claims, you're able to describe, which would you describe as be somewhat nimble in how you come in and what you address.
Yeah.
If you have the hangover of the historical, you may not have the guts to be able to do something like that, because you have the lingering effects of what the past. And so
Yeah.
I think inside the company, it's probably hard culturally for the senior management to buy in on, hey, let's go back in on that after you've been burnt so much for it.
Yeah. And then do you think that the conditions that, birth the environmental market, as you said, is that a different kind of scenario from the stresses of today? So you're less likely to see a new kind of vertical offering or sub-segment emerge, and it's more of a broad brush issue?
Well, I think let's take excess casualty, for example. I mean, that's a stress point. So what carriers have done is they've continued to reduce the amount of limits they're going to offer on any single risk.
Yeah.
And then clearly if you look at the market segments, let's say, for example, Fortune 5 business, they have difficult time finding the capacity they may want to carry.
Yeah.
And so part of the, I guess, the creation has been over time facilities out of Bermuda, and also sharing capacity there, where you get 3 or 4 companies come in, offer up a block limit, kind of quota share arrangement, with a larger retention for the insured. So maybe it's a Fortune 5 could take the first 5 or 10 million of a retention to build up to that first 100 million, and then you have four or 5 companies in the next 90, let's say, that are sitting there on a quota share basis. So you see some of that uniqueness coming through.
Yeah.
And then the difference with, let's say, the Bermuda forms would be those forms in the jurisdiction of Bermuda is more favorable on the carrier side on how they handle claims and respond to claim and defense issues than it would be in the United States.
Yeah. Yeah. That's interesting. I was curious if like ILS and other kind of bond offerings might be another, just different ways of structuring the capital or providing it. Do you see that coming into casualty as well?
I mean, we see some of that. It's very complex, or cat bonds for that matter.
Yeah.
Similar situation. There's some markets that specialize in that and do a great job with that, but there's also I would say there's a good return on that.
Yeah.
But then there's a lot of downside on that too. So,
Yeah.
and there's been some carriers that have performed very poorly with alternative risk, if you will.
Yeah. I'm just thinking about the alternative forms of capital coming in to fund the litigation on the, PE and others who are doing the litigation funding. Is there an analog on the insurance side where it's sort of new forms of capital backing the cover itself? And I mean, I don't know that you'd have people taking bets on both sides of that equation, and they've pretty clearly been taking them on the plaintiff side. Um, but it is interesting whether there's changes in the capital provision or, the sources of capital, and if that's part of what drives sort of long-term capabilities here.
Part of it is, and I would say there's also you always have the aspect of regulatorial issues, over the
Yeah.
industry, rightfully so. So you get some companies just structurally can't offer some of those alternative products. They just don't have the regulatorial filings and approvals to do
Yeah.
it. Others, are set up legally that they can do different things than, let's say, a traditional PNC company.
Yeah. So David, one of the things that I know has been tricky for a lot of carriers is bringing in new talent. As we talk about the challenges that we all face, it's not always the most attractive story to getting folks to be like, yeah, I want to sign up for work in this industry. I know talent's important to you. How do you deal with that to make sure we have that future talent and it's developed and supported, especially in more remote working situations? That's an even bigger issue. Talent's important to you. What do you see that? How do you see that fitting in with sustaining things?
All right, so I'm very passionate about bringing in either whether that's early career professionals into our business or those people that maybe decided to take a change in their career at mid-career point of their and we need to continue to prime, if you will, the industry with talent. I actually was a finance and I double majored in insurance and came out of college wanting to get in the insurance industry. I find it very rewarding,
Yeah.
and it's a career path that I would never have changed in all these years. So there's different ways we can do that. We can go as a carriers or on the broker side, distribution side. There's on-campus recruiting opportunities, seeking out people that are managing in risk management, environmental studies, for example, or areas like finance, actuary, accounting, claims professionals. There's multiple areas of this insurance business that one can find a role in. So I think the industry we can work with organizations like the Insurance Information Institute or American Property Casualty Association to promote our industry and bring in pipeline folks into the business and invest in their careers. And there's also opportunities I've seen in my career where, let's say somebody comes out of the military, they're looking for, they've spent a 23, 4, 5 years in the military and looking for something. There's a lot of opportunities for people like that to apply their skills and what they've learned, let's say in the claims department or special investigations department of an insurance company.
In claims, we love military police backgrounds. It tends to work really, really nicely for a lot of the claims work. Am I right that you work with Spencer as well as Spencer Education Foundation?
Right. Argo is involved with the Spencer Foundation and trying to recruit. We bring interns into the company. We'll have one here in Chicago this summer.
That's great.
And we also participate in a program called Ascend with Argo, where we partner with our brokers, bringing in young career professionals. We just had an event 2 weeks ago in our New York City office where we partnered with a broker, had 12 young career professionals come over on the broker side and spend a day in our office and shadow our underwriters and listen to our senior management about the operations of an insurance carrier.
In the spirit of the show, future, I kind of want to end on that note is lots of challenges today. There's plenty of carriers who are struggling with it. It's great to hear from someone who continues to, offer coverage and find ways to do that effectively. What's your overall take? Is it a moment of difficulty that's hard to see, kind of that there's a light at the end of the tunnel? Do you have hope for it? Are there things that need to happen to make it, because the coverage is needed? So what's your kind of longer term take on things? Is it hopeful or pessimistic or what?
Uh, so, if you look at the overall industry results for, let's say, 2022, 23, 24, there's certainly pain points in liability insurance overall. And if you go in and then split up, segregate liability, for example, into other liability, a lot of carriers book liability insurance in that quote unquote other liability segment, which is really a big segment. If you look at it, that could be comp, that could be GL, that could be excess, could be umbrella.
Yeah.
personally, I'm on my soapbox, and I have been for a number of years on commercial automobile liability insurance and commercial, and what I mean by that is that if you go back to the late 80s, I'll say 87, 89-ish, let's say, is when, is a general statement, the insurance industry required a $1 million combined single limit auto policy for the excess or the umbrella to attach over.
Yeah.
You adjust that for inflation.
Yeah.
Today,
it's not that much
that
money.
$1 million is under $400,000.
Yeah. Yeah.
And so as an industry, that is why there's so much, if you look at the larger verdicts, over 50% of those losses are either product liability or auto liability.
Yeah.
Okay. And so as an industry, we're trying to make profit writing direct excess over a $1 million auto limit. It'll never work.
Yeah.
It'll never work. So as an industry, we have to address this. And I think personally that it's best addressed by increasing the auto limits, because you have ISO rates, you have ISO increased limit factors. Actuarially, you have better capabilities of pricing that product with the higher limits on that commercial auto policy versus trying to do it in your excess or your umbrella. So we really need to take that million up to 2 million, and some risk, it probably should be $3 million.
Yeah, I was gonna say 2 is still behind the $1 million in the 80s.
Yes.
Yeah.
Yeah. And if you talk to the any carrier claim adjusters, that they'll tell you that's the pain points, because even a single injury auto claim can blow through that $500,000-$600,000 figure pretty quickly.
Yeah, really easily.
And so that's the issue on capacity. That's the issue where Plaintiff Bar has done a lot of work attacking those automobile accidents. It's interesting, I think, you think about auto safety and all the improvements that are now in a modern automobile with respects to steering and braking and auto alarms and different devices inside that automobile or around that automobile. And they're all defeated by one thing, and it's a cell phone.
Yeah.
And it's distracted driving.
Yeah.
And, so we got a lot of work to do as an industry to address this.
Yeah. There are some solutions out there to help with it, and people are people, and they will find ways to get around them, unfortunately. So yeah, there's a ways to go. I just on the highway before we sat down, and the number of people who were not actually looking at the highway was not settling for me.
It's amazing. I live about a mile from our office here in Chicago. I walk to work and walk home to work, and as across the streets in Chicago, as you're at the light ready to cross the street, and you see you will come through, and it's just texting and driving.
Yep. Well, I appreciate the time today. It's, as I say, it's an interesting perspective that I feel like with all the hail and hurricane and wildfire activity, we've sort of forgotten that there's another half of the industry that also has things that it deals with. So I appreciate you coming on and sharing a bit about the casualty world today.
Well, thank you for having me, Brian. I really appreciate the opportunity.